In this episode, we're going to discuss equity rollovers, and that's where a seller retains a piece of the company for a future event. In the last 12 months, Bill and I have been involved in 4 different transactions that involved an S-Corporation and either a private equity group or another S-Corp or LLC buying a portion of the business. And there are some strategies or strategic tools that are used to do this. Now, when you start talking about these tools to a buyer or a seller, they can be a little bit overwhelming. So I thought in this video, we would talk about at a macro level what a 338H10 and an F-Reorganization is, and why a buyer and seller would want to use these in putting a transaction together. So if you're a buyer or a seller, stick around, because I think these 2 strategic tools put together can answer a lot of questions and solve some of your problems in a transaction. As always, if you've got a question as I go through this presentation, just leave it in the comment section below and/or send me an email and I'll get back to you as soon as I can. In addition, if you find this episode helpful, please hit that like and subscribe button. And with that, let's talk about 2 particular tools or structures that are being used, especially when you have an S-Corp as a seller. And that is the 338H10, which we've covered in another episode, and I'll put a link in the section below, and the F-Reorganization. Let's talk about the first strategic tool that is being used, and we're seeing this more and more often in transactions, especially in an equity rollover on a company or an S-Corporation, and that is the use of a 338H10. Now, there's some pros and cons for both the buyer and the seller in using this structure. Number 1 for the buyer is they get a step up in the cost of the assets. So that allows them to redepreciate assets, claim some amortization of goodwill. For the seller, they've got a higher tax burden, usually in this case. The buyer and the sellers have to agree to this structure, so it's got to be done, and the buyer has to purchase at least 80% of the corporation in this type of a structure. Seen it done where it's used in 100% or in equity rollovers where it's 80%. And the seller is going to have to pay or may have to pay capital gains on the entire sale, whether it's 80% or not. So not a perfect tool, but we do see this being used in conjunction with an F-Reorganization. The second tool is an F-Reorganization. Okay, what's an F-Reorganization? Well, at a very high level, an F-Reorganization is the change in a legal structure without changing any of the company's day-to-day operations. So you could be changing the entity, the location, or the place of the corporation going through this process. Now, what is the pros and cons for the buyer and the seller? Well, for the buyer, same as the 338H10, they get a step up in the basis, and as well as they're not limited to purchasing at least 80%. They can purchase 50% or whatever percent they want. And it's got to be used in conjunction with the purchase of an S-Corporation. For the seller, the portion that they retain, they don't have to have or won't be charged capital gains on that. So in a transaction where you have a private equity group or another LLC or S-Corporation purchasing the S-Corporation, it can be done as using the 338H10 and an F-Reorganization as a stock sale legally, an asset sale, but they don't have to purchase that 80%. So it allows somebody to come in and buy 50% of the company and the seller to retain 50% going forward, and they'll pay whenever there's another equity event down the road. both parties will end up paying capital gains or gains on that. It also allows the company, the target or the seller, to retain its EIN number, its contracts, customers, and vendors that are in place. And this is often why it's used, is that the seller has got specific contracts or relationships, and those a new buyer doesn't want to have to go through the process of maybe doing consent or going through the process, but it allows the organization to be purchased as a stock sale, buyer as an LLC or an S corporation, and the seller being an S corporation. So when you use both of these tools together, it strategically works for a buyer, and especially in an equity rollover event where the seller's retaining a portion of the business for that seller as well. So with that said, what's an F reorganization? Well, let's take a look at how you would go through an F reorganization a step at a time. An F reorganization is defined as merely a change in the identity, form, or place of an organization, and is limited to an S corporation. So the first step in this process is for the shareholders of the existing corporation, and we'll call it OldCo, to go out and form a new S corporation and obtain a new EIN number. The old corporation, and we'll call it OldCo from now on, just retains its EIN number. Operations, nothing changes in step one in the company or this process. In step two, the shareholders of OldCo exchange their stock on a one-for-one basis for shares in NewCo. And as a result of that, NewCo now owns the OldCo as a subsidiary. There's no change in the day-to-day activities of OldCo. It retains all its business. It's just nothing changes with the regards of the day-to-day operation. OldCo retains all the business assets, business contracts, licenses, and EIN numbers. In step three, we're simply recognizing the steps 1 and 2 and what's taken place, where OldCo has now become a wholly owned subsidiary of NewCo, and NewCo is now the sole owner of OldCo. Step 4 can be a little confusing, but this is where NewCo elects to file a Q-sub election for OldCo. In doing this, it's a qualified subchapter S subsidiary election for OldCo by filing IRS Form 8869. And at this point, OldCo is now disregarded as a separate entity for federal tax purposes. So what you've basically done is complete that parent-child relationship where NewCo is in effect owns OldCo as a subsidiary, and it's like a branch or a department. Now, OldCo retains its EIN numbers and still has, for if you've got payroll, federal taxes associated with payroll or benefits, it's got to continue to file those using its EIN numbers. But for all purposes, everything flows through NewCo at this point. In step 5, the Q-sub is converted to an LLC. OldCo converts to a single-member LLC wholly owned by NewCo. NewCo makes an election using IRS Form 8869. Now, for tax purposes, the LLC remains disregarded or treated as just part of NewCo, but now offers a great deal of flexibility in the sale of the business when it comes to the transaction. Again, the F-Reorg sets it up for the 338H10. So what are the benefits of an F reorganization? Well, there's really 4 of them. Continuity, where the structure is treated as a single continuing entity. Preservation of the S-Corp election original tax attributes retain at the new co level. So old co goes straight to new co. Flexibility in closing, and this aligns really for the purposes of a 338H10 purchase where you're doing a stock sale, but it's legally, or for IRS purposes, it's an asset sale. And then clean entity for the transaction, where Oldco becomes an LLC and it's easier for a new corporation to take this on. In step 6, the transaction actually takes place. By going through the F-Reorg, you're now free to use the 338H10 vehicle, which again is a stock purchase, but for tax purposes is an asset sale for the S corporation to actually buy the Oldco. And this is very effective and allows another S corporation to buy an LLC or another S corporation, and being able to treat it again as a stock sale, but for tax purposes, it's an asset sale. So this is why they use this structure, and again, it's used a lot in equity rollovers where you've got a seller retaining a portion of the business on a go-forward basis, but allows for an LLC or an S corporation by using this structure and process to purchase another S corporation. So let's talk about the seller and buyer tax consequences. For the buyer, they're going to receive a step up in basis on the assets. They're going to be able to depreciate or amortize the goodwill over 15 years. And the depreciation reset on tangible assets that they're purchasing. So if they bought a piece of equipment and they valued it at, say, $100,000, they would be able to depreciate that going forward. And by increasing the depreciation expense, and amortization expense, it actually increases the cash flow or after-tax cash flow to the new owners. And then lastly, they're able to keep that S election. Now you know more about F-Reorganizations and the use of a 338H10 than you've ever wanted to know. But if you're a buyer or seller looking to purchase an S corporation and the buyer is an LLC or an S corporation, this structure and strategy offers a lot of flexibility, whether there is the seller retaining a piece of equity on an equity rollover, or the company's just simply buying 100%. And we see these especially when there are contracts or licensing in the target or the seller company that needs to be retained. The buyer is another S corporation or LLC. So as always, we always advise you to talk to your tax attorney or tax advisor when evaluating a structure like this. But we just wanted to, at a macro level, walk you through it so that you don't look like a deer in headlights when you're actually talking to another professional advisor about doing this. So I hope you got something out of this episode, and if you did, please hit the like and subscribe button, and we'll see all of you on the next episode.